Hi, this is Peter Gaylord. I'm the CEO of Gaylord and Belinsky Wealth Management. What I want to talk to you about today is first some of the key determinants that will guide your long-term investing success, and then I'm going to talk a bit about our core investing philosophy. So first, let's start by looking at what really drives your success as an investor. And there really are three factors. First is your savings rate. The more you can contribute on a regular basis, of course, the more you will accumulate over time. Now, most people are fixated or focused quite a bit on the next factor, which is, of course, your annual rate of return. If you can compound your holdings at a very reasonable rate, you're going to get rich over time. And the higher that rate, the more you can expect to accumulate. Of course, with additional returns, higher returns, you often have greater risk. So there is a flip side there, and it's incumbent on an investor to be careful that they don't become overly aggressive, as they could incur great losses, much more likely if they're trying to go for very high rates of return. Now, the third factor, and one that most or many investors don't think about that often, is avoiding big losses. Now, this is a really key issue. We've seen it take place a couple of times in just the last decade, first with the tech stocks in the year 2000, and more recently with the financial crisis of 2008. And the issue there is that we saw major losses of about 50% on both of those occasions. And if you incur a major loss of 50%, of course, you subsequently have to double the size of your portfolio just to get back to where you were. So if you can, in effect, step out of the way of a freight train when a market calamity like that is coming, to the extent we can see it, you're going to do much better. And this is probably a bigger factor than trying to go for bigger gains. Oftentimes people stay in too late in the game, and that's why they incur those major losses. So in a moment, now I'm going to shift gears and we're going to talk a bit about our investment philosophy. So now, as I mentioned, I would like to change gears a little bit and talk about our investment philosophy. We think there are four major factors to consider in your investing. The first is that many investors have limited their investments or their portfolios to the United States, whether in securities, in equities, I should say, or fixed income. And we believe that in today's environment, one has to think about investing on a global basis. Now, I've done another video where we talked a bit about emerging markets and frontier markets, and the fact that those markets in 10 years are expected to be 50% of global GDP. So with that in mind, not to mention developed markets in Europe, Japan, and other places in the Far East, we think it's very important that an investor now look at investing on a global basis. So that's the first factor that we think is important. The second is that while the market today looks pretty healthy, valuations are still reasonable in historic terms, there's always the likelihood that another calamity or event, future shock of some sort, like the tech stock crash around the year 2000 and the financial crisis of 2008, could occur again. So we always want to be on the lookout for those types of events, and shouldn't be surprised if they occur. We had some issues in recent years, like the situation in Europe, where there was an issue there where a lot of particularly the southern tier countries, what they called the pigs, Portugal, Italy, Ireland, Greece, and Spain, had some serious problems, and it looked like there might have been a breakup of the euro, the failure of the euro. And of course that led to a lot of concern in Europe Fortunately, that situation seems to have come and passed, and it appears right now that Europe is on the mend, but that was a situation that occurred more recently. So when things like that happen, we are going to watch the situation very closely. And that leads us to the next point, which is we think it's better to forego some gains than to stay in the game too late and wind up incurring some major losses. Now finally, the last point is that we like to employ strategic asset allocation. I've talked about that in some of my other videos, but the key fact is that you want to look at the allocation that you have between different asset classes and then periodically rebalance those allocations. As gains are made in one asset class, you'll take some profits. When a particular asset class is down, we want to do additional investments there. And by doing that discipline, that forces us to sell when we've realized gains and to purchase when prices are beaten down in an asset class. That stops the investor from doing the process that many people do, which is to be driven by their emotions and to buy when they feel the market's safe after a long run-up, or to sell when they get into a panic type situation when the market's had big losses. So by using strategic asset allocation, rebalancing, and putting those two practices together, we can remove the emotion that occurs, that frequently drives many investors. So those are our key factors in our investment philosophy. If you need a financial advisor or would like to learn more, please contact us. Our contact information is in the comments section below. Also, you can take a look at our website, GaylordBelinsky.com, or follow us on Twitter. Our handle there is @GaylordBelinsky, as you see on the board behind me. So, thanks very much for watching, and we hope this has been helpful.